The silver market, at least as reflected in today's headlines and price screens, appears calm on the surface, with futures prices oscillating within familiar ranges and official commentary continuing to describe recent movements as routine volatility driven by macroeconomic expectations, interest rate speculation, or transient demand fluctuations. Yet beneath this outward appearance of stability, a far more consequential development has been unfolding, one that rarely enters mainstream coverage and is often dismissed when it does, because it challenges the foundational assumptions upon which modern commodity pricing depends. What is being framed publicly as a normal market correction is, in reality, a structural exposure of how concentrated control, paper leverage, and physical scarcity intersect in a way that leaves the retail participant effectively locked out of the system. By the end of this analysis, it will be clear that the issue is not merely about price direction or short-term sentiment, but about who controls access to real metal and what happens when that control becomes too concentrated to ignore, raising a question that cannot be resolved by a single data point or policy response. If the price of silver is set in markets where most participants can never access delivery, what exactly is that price measuring anymore? For decades, the prevailing understanding of the silver market has rested on the belief that it is deep, liquid, and self-correcting, supported by futures exchanges that allow producers, consumers, and financial participants to hedge risk efficiently while ensuring that physical supply remains available to those who genuinely need it. In this framework, futures contracts are not seen as distortions but as essential tools that smooth price discovery, allocate risk, and connect global supply with global demand, all under the assumption that delivery mechanisms exist as a credible backstop rather than a frequently exercised option. The vast majority of contracts are expected to settle financially, not because delivery is impossible, but because market participants are presumed to prefer cash efficiency over logistical complexity, a preference that reinforces the illusion that paper and physical markets are seamlessly interchangeable. This belief has been reinforced by decades of relatively orderly functioning, during which inventory reports, delivery statistics, and vault disclosures appeared sufficient to reassure observers that any imbalance would be temporary and quickly resolved through arbitrage. However, that confidence depends entirely on a set of assumptions that are now visibly eroding, even if the implications have not yet been fully acknowledged. It assumes that registered inventories represent metal that is genuinely available rather than nominally assigned, that large participants will behave as liquidity providers rather than strategic accumulators, and that delivery demands will remain marginal relative to total open interest. Most importantly, it assumes that no single entity or small group of entities will systematically absorb physical supply at scale while continuing to operate within the same structures that define the paper market. As recent delivery data and inventory movements suggest, these assumptions are no longer holding in the way they once did, and the resulting stress is beginning to surface not through dramatic price spikes, but through subtle divergences that signal a deeper imbalance already in motion. History offers no shortage of examples where markets dependent on confidence and continuity appeared stable right up until the moment they were not, and the silver market itself has experienced episodes where leverage, concentration, and delivery pressure collided with destabilizing results. One of the most frequently cited precedents is the late 1970s silver episode, when aggressive accumulation and constrained supply exposed vulnerabilities in a system that had assumed physical availability would remain sufficient under all conditions. At the time, authorities responded with rule changes, margin adjustments, and regulatory interventions designed to restore order and reassert control. And while those measures succeeded in breaking speculative excess, they also left a lasting imprint on how commodity markets are structured and supervised. The lesson drawn from that period was not that concentration is impossible, but that it becomes dangerous when it accelerates faster than institutional responses can adapt. What makes the present moment particularly instructive is not the repetition of past mistakes, but the refinement of strategy that has occurred since then, as large institutions have learned how to operate within regulatory boundaries while still achieving outcomes that were once considered implausible. Instead of overt attempts to corner markets through visible leverage, accumulation can now occur quietly through delivery mechanisms, vault control, and account structuring that disperse visibility while consolidating ownership. This evolution has made it more difficult for observers to recognize when a threshold is being crossed because the signals are distributed across inventory reports, delivery notices, and retail availability rather than concentrated in a single dramatic event. As these patterns begin to align, the similarities to earlier episodes become harder to dismiss, even as the context in which they unfold has fundamentally changed. The emerging pattern is one that repeats across financial history, where systems built on assumptions of participation and trust begin to strain when access becomes asymmetrical, and when those with structural advantages are able to extract value while others are confined to observation. Early warnings are often ignored precisely because the system continues to function in a narrow technical sense. Prices continue to print, contracts continue to trade, and official mechanisms remain intact, giving the impression that concerns are exaggerated or premature. Yet it is precisely during these phases that the most consequential shifts occur, because control over real assets can change hands long before price signals are forced to adjust. When the gap between paper representation and physical reality widens, the market does not fail all at once, but gradually transforms into something fundamentally different from what participants believe it to be. What distinguishes the current situation from previous episodes is not simply the scale of accumulation or the concentration of control, but the environment in which these developments are taking place. An environment defined by depleted buffers, fragmented supply chains, and geopolitical constraints that sharply limit flexibility. Unlike earlier periods when new supply could be mobilized relatively quickly, or when strategic reserves provided a margin of safety, today's silver market operates under conditions where industrial demand is rising, mine supply growth is constrained, and geopolitical considerations increasingly shape trade flows. These factors compress the system's ability to absorb shocks and reduce the effectiveness of traditional responses, making it far more sensitive to sustained delivery pressure than headline prices alone would suggest. As these pressures converge, the near-term window becomes increasingly important, not because it guarantees an immediate crisis, but because it represents a period during which latent vulnerabilities can become visible with little warning. Delivery cycles, inventory drawdowns, and policy decisions intersect in ways that leave little room for gradual adjustment, forcing outcomes to be determined by constraint rather than coordination. In such an environment, reassurances based on historical norms lose their credibility, not because they are intentionally misleading, but because the underlying conditions that once supported them no longer exist in the same form. This is where narrative stability diverges from structural resilience, and where confidence can persist even as the foundation supporting it weakens. The critical issue, then, is not whether silver prices will rise or fall in the coming weeks, but whether the market structure that has long governed price discovery remains capable of reconciling paper claims with physical availability in a way that is accessible beyond a narrow circle of institutional participants. If that reconciliation fails, the consequences will not be confined to a single asset class, but will ripple outward, challenging assumptions about how commodities are valued, how risk is distributed, and who ultimately bears the cost when structural imbalances are allowed to accumulate unchecked. This is not a question that can be resolved by official statements or incremental adjustments, but one that will be answered by the actions of those who control supply, and by the constraints that increasingly define what is possible rather than what is intended. The historical precedent most often overlooked in discussions of market stability is not the dramatic moment of collapse itself, but the prolonged period beforehand during which warning signals were visible yet systematically discounted. In prior episodes where commodity systems came under strain, confidence did not evaporate overnight, nor did authorities immediately lose control. Instead, stress accumulated quietly through inventory drawdowns, delivery bottlenecks, and increasingly concentrated positions that altered the balance of power without triggering immediate price responses. What ultimately undermined those systems was not a lack of rules or oversight, but the assumption that existing mechanisms would function indefinitely under conditions that were already changing. The silver market today exhibits many of these same characteristics, where official metrics suggest adequacy while underlying availability becomes increasingly constrained. In earlier periods of commodity stress, including episodes in energy markets, base metals, and precious metals alike, Institutional actors often responded to rising pressure by increasing their reliance on financial settlement rather than physical exchange, reinforcing the perception that delivery was a formality rather than a necessity. This behavior temporarily preserved liquidity and price continuity, but it also widened the gap between nominal supply and accessible supply, a divergence that only became apparent when delivery was demanded at scale. The lesson from those periods was not that markets are inherently fragile, but that they become vulnerable when the mechanisms designed to absorb stress are repurposed to defer it. By the time delivery failures or emergency interventions occurred, the imbalance had already reached a point where corrective measures imposed costs far exceeding those that would have been incurred through earlier adjustment. Applying this lens to the present silver market reveals a familiar pattern, one in which confidence persists because outcomes have not yet forced a reckoning, even as the conditions necessary for that confidence erode. The futures market continues to operate smoothly. Open interest remains elevated, and official inventories still appear sufficient on paper, all of which reinforce the belief that concerns about concentration or scarcity are overstated. Yet beneath these indicators lies a reality in which physical metal is increasingly treated not as a neutral commodity, but as a strategic asset, accumulated deliberately by entities with the balance sheet capacity and infrastructural access to do so without attracting immediate scrutiny. This shift changes the function of the market itself, transforming it from a venue for price discovery into a mechanism through which supply is redistributed toward those best positioned to exploit its design. The recurring pattern becomes clearer when one considers how stress signals are typically misinterpreted during such transitions. Inventory declines are often explained away as seasonal fluctuations or logistical adjustments. Delivery spikes are attributed to isolated events, and retail shortages are dismissed as transient demand surges rather than symptoms of wholesale extraction. Each explanation is plausible in isolation, but together they form a narrative that obscures the cumulative effect of sustained pressure. This fragmentation of perception allows structural changes to proceed largely unnoticed until they reach a point where reversal becomes difficult, if not impossible. The silver market's current trajectory reflects this dynamic, where no single data point appears alarming, yet the aggregate trend suggests a system operating ever closer to its constraints. What makes the present situation materially different from historical parallels is the absence of meaningful slack within the system, both in terms of physical supply and institutional flexibility. Previous episodes unfolded in environments where new production could be incentivized through higher prices, strategic stockpiles could be mobilized, or policy coordination could restore confidence by expanding liquidity. Today, those options are far more limited, as mine supply growth remains constrained by geological, regulatory, and capital factors, while strategic reserves have been depleted or reclassified in ways that reduce their availability as buffers. At the same time, industrial demand for silver has become more inelastic, tied to applications that cannot easily substitute away from physical metal without significant cost or disruption. These constraints fundamentally alter the calculus of response, because they reduce the effectiveness of measures that once served to stabilize markets during periods of stress. Higher prices may encourage marginal supply over time, but they do little to address near-term delivery obligations, particularly when accumulated inventories are held by entities with no incentive to release them back into circulation. Similarly, regulatory interventions aimed at preserving orderly trading can inadvertently reinforce concentration by discouraging smaller participants while leaving large incumbents largely unaffected. The result is a system in which control becomes increasingly centralized, not through overt manipulation, but through the quiet accumulation of advantages embedded within the market's own architecture. As this centralization progresses, the near-term pressure window narrows, defined less by a specific date than by the convergence of delivery cycles, inventory thresholds, and policy inflection points. During this window, outcomes become increasingly sensitive to relatively small triggers, such as an unexpected surge in delivery demand, a disruption in supply flows, or a shift in regulatory posture that alters participant behavior. In such an environment, market responses tend to be reactive rather than proactive, driven by the need to manage immediate constraints rather than to preserve long-term stability. This reactive posture increases volatility not necessarily in price, but in availability, as access to physical metal becomes contingent on relationships and infrastructure rather than transparent market mechanisms. The narratives advanced during these periods often focus on reassurance, emphasizing the resilience of existing systems and the historical ability of markets to adapt. While such narratives may succeed in maintaining surface-level confidence, they do little to address the underlying reality that resilience depends on dispersion of access and optionality, both of which are diminishing. The distinction between narrative stability and structural resilience becomes increasingly important here, because a system can appear orderly right up until the moment its constraints are breached. When that moment arrives, adjustments tend to be abrupt, uneven, and disproportionately borne by those with the least access to institutional channels. The central question, therefore, is not whether the silver market will experience volatility, but whether the mechanisms through which volatility is absorbed remain aligned with the needs of a broad participant base. If access to physical metal continues to concentrate, while the majority of participants remain confined to paper representations, the market risks evolving into a bifurcated structure where price signals lose relevance for those unable to act on them. Such a transformation would not announce itself with a dramatic failure, but with a gradual normalization of exclusion, as retail participants find themselves increasingly unable to translate market prices into tangible outcomes. The distinction between past episodes of market stress and the present environment becomes even clearer when examining the structural limitations that now define the silver market's operating range. Unlike earlier periods when excess inventories or underutilized production capacity provided a cushion against sustained delivery pressure, today's system is characterized by tight margins and long lead times that severely constrain flexibility. Mining output has struggled to expand meaningfully despite rising demand, not because prices have failed to signal scarcity, but because the underlying economics of silver production are tied to broader base metal operations that cannot be adjusted quickly or independently. This structural dependency limits the market's ability to respond dynamically, ensuring that any sustained imbalance persists far longer than traditional models would predict. At the same time, geopolitical fragmentation has reshaped global trade flows in ways that further reduce the system's capacity to self-correct. Export controls, strategic stockpiling, and regional prioritization of critical materials have become increasingly common as governments reassess the vulnerabilities exposed by recent supply chain disruptions. In this environment, silver is no longer treated solely as a financial asset or industrial input, but as a strategic material whose availability carries implications beyond price. These shifts introduce friction into what was once a relatively fluid global market, complicating arbitrage and limiting the ability of participants to source metal from alternative regions when local inventories are drawn down. Institutional behavior has adapted accordingly, favoring accumulation and retention over distribution, particularly among entities with the infrastructure to store and deploy physical metal strategically. This behavior is rational within the context of constrained supply and rising geopolitical uncertainty, but it has profound implications for market structure, as it concentrates control over deliverable metal in fewer hands. When such concentration reaches a critical mass, it alters incentives across the system, encouraging defensive behavior among other participants and reinforcing the cycle of hoarding and scarcity. The market becomes less about exchange and more about preservation, with liquidity increasingly confined to paper representations that do not require physical settlement. The near-term pressure window emerges from this backdrop as a period in which latent constraints are most likely to assert themselves, not through deliberate action, but through the natural rhythm of market operations. Delivery months, inventory reporting cycles, and policy announcements converge to create moments where demand for physical metal must be met or deferred, and where deferral itself becomes increasingly costly. During these moments, even modest disruptions can have outsized effects because the system lacks the slack necessary to absorb them without visible consequences. It is in these windows that the true balance of power within the market is revealed, as those with access to physical supply dictate terms while others are forced to adapt. Competing stakeholders approach this window with fundamentally different priorities, further complicating the outlook. Industrial consumers seek continuity of supply to maintain production, Financial institutions prioritize balance sheet stability and risk management, and policymakers aim to preserve orderly markets while avoiding signals that could undermine confidence. These objectives are not inherently incompatible, but under conditions of scarcity, they can become mutually constraining, forcing trade-offs that expose underlying hierarchies. When supply cannot satisfy all demands simultaneously, allocation becomes a function of leverage rather than price alone, reinforcing disparities between institutional and retail participants. As pressures intensify, market and policy responses tend to become increasingly reactive, shaped by immediate constraints rather than strategic foresight. Emergency measures, whether in the form of regulatory adjustments, messaging campaigns, or temporary liquidity provisions, may succeed in delaying overt disruption, but they often do so by reinforcing the very structures that contribute to imbalance. By privileging continuity over reform, such responses can entrench concentration and reduce transparency, leaving the system more brittle over time. This dynamic underscores the difficulty of addressing structural issues within frameworks designed primarily to manage short-term volatility. Public narratives during these periods often emphasize resilience, drawing on historical examples where markets weathered stress and eventually normalized. While such narratives may provide reassurance, they risk obscuring the fundamental differences that define the current environment, particularly the absence of surplus capacity and the heightened strategic value of physical assets. The danger lies not in optimism itself, but in the assumption that past outcomes guarantee future ones, despite clear evidence that the underlying conditions have changed. When narratives diverge too sharply from reality, they delay recognition of problems until corrective action becomes more disruptive than preventative adjustment would have been. The implications for retail participants are especially pronounced, as their access to the market is mediated almost entirely through instruments that depend on institutional infrastructure they cannot reach. While prices displayed on screens may suggest opportunity, the practical ability to convert those prices into ownership of physical metal becomes increasingly constrained. This disconnect erodes trust not only in specific markets, but in the broader promise that open participation underpins modern financial systems. As exclusion becomes normalized, the risk is not merely financial loss, but a deeper skepticism toward the mechanisms that claim to represent fair and efficient exchange. These developments do not point to an inevitable or imminent collapse, but they do indicate a system operating under mounting strain, where the margin for error continues to narrow. The critical question is whether recognition of these constraints will prompt meaningful adaptation, or whether the market will continue to rely on structures that assume conditions which no longer exist. As the pressure window approaches its inflection point, the answer to that question will shape not only the future of the silver market, but the credibility of the frameworks that govern commodity pricing more broadly. As the analysis comes full circle, it becomes necessary to confront the gap between how the silver market is commonly explained and how it is increasingly functioning in practice. Much of the public commentary continues to focus on price movements as the primary indicator of market health, treating volatility as both the problem and the signal, while overlooking the more consequential issue of access. A market can sustain relatively stable prices even as its underlying structure deteriorates, particularly when paper instruments dominate trading volume and physical settlement remains the exception rather than the rule. In such conditions, price becomes a reflection of financial positioning rather than physical reality. And confidence persists precisely because the mechanisms that would force reconciliation remain largely unused. This is where misconceptions take root and are reinforced through narrative management rather than structural analysis. Assertions that inventories remain sufficient, that delivery mechanisms are intact, or that market concentration reflects efficiency rather than risk often rely on narrowly defined metrics that fail to capture how control is exercised within the system. Registered inventories may appear ample on paper, yet availability depends on willingness to release metal, not merely on its classification. Similarly, assurances that retail participants are unaffected by institutional behavior ignore the practical reality that exclusion does not require explicit prohibition, only the gradual elevation of barriers that render participation impractical. These narratives are not necessarily false in isolation, but they are incomplete in ways that obscure the system's trajectory, The distinction between narrative stability and actual resilience becomes especially important in this context, because stability maintained through deferral and concentration is inherently fragile. When confidence is sustained by assuming that stress will remain contained, rather than by ensuring that access and optionality are broadly distributed, the system's ability to absorb shocks diminishes over time. What appears orderly under normal conditions can become rigid under pressure, leaving fewer pathways for adjustment when circumstances change. In the silver market, this rigidity manifests not as a dramatic breakdown, but as a quiet narrowing of who can act and who must simply observe. Framing the situation as an ongoing process rather than a discrete event is essential to understanding its implications. There is no single moment at which control suddenly shifts or access abruptly disappears. Instead, these outcomes emerge incrementally as incentives align and constraints tighten. Each delivery cycle that draws down physical inventories, each period of elevated demand that is met through paper settlement rather than metal, and each regulatory response that prioritizes continuity over dispersion contributes to a cumulative transformation. Over time, the market evolves into a structure where the majority of participants interact with representations of silver, while a minority exercises effective control over the metal itself. The broader significance of this transformation extends beyond silver alone, touching on fundamental questions about how commodity markets function in an era defined by scarcity, strategic competition, and institutional concentration. If pricing mechanisms become increasingly detached from physical accessibility, the role of markets as neutral allocators of resources comes into question, replaced by systems that reflect existing hierarchies rather than collective demand. This shift has implications not only for investors, but for industries, policymakers, and consumers, whose decisions depend on credible signals about availability and cost. Two questions, therefore, remain unresolved and demand careful consideration as developments continue to unfold. First, can a market built on the assumption of broad participation remain credible when access to its underlying asset is effectively restricted to a narrow group of institutions? Second, if price no longer guarantees availability, how should participants interpret signals that were once considered authoritative indicators of value? These are not abstract concerns, but practical ones that will shape behavior and outcomes long before any formal acknowledgement of structural change occurs. As this situation continues to evolve, staying attentive to developments before they crystallize into headline crises becomes increasingly important. The dynamics discussed here are not static, and their consequences will emerge through patterns rather than proclamations. For those seeking to understand how control, scarcity, and market structure interact beneath the surface of daily price movements, continued analysis will be essential because by the time these issues dominate public discourse, the most consequential shifts will already have taken place.